There really shouldn't be any doubt. Historically, we are very expensive on pretty much any metric. The stocks are expensive, Bitcoin is expensive. So the question is, what is the best behavior during times like this? Now, I've showed this several times on this channel. This is the Shiller PE ratio. This is a 7-year moving average of the price to earnings ratio for US equities. And this is a very long-term chart that starts in 1871. So this is 150 years of data. Over here, we've got the Great Depression. Over here, we've got the dot-com bubble burst. Over here, we've got the global financial crisis. And the little blip over here is the COVID crash. And so there's no doubt that currently we aren't very cheap. The question is, what should we do? Here's another very similar metric. Again, this is not the first time I'm showing this on this channel. This is the Buffett indicator. This looks at the market cap of all of US equity relative to the GDP of the USA. This chart is quote unquote only 55 years in duration, but still we can see the same kinds of events, right? Over here, the dot-com bubble burst, over here, the global financial crisis, and we had our correction in 2022. The COVID crash is over here. Again, just a small blip. Now, there should not be any doubt that buying the future earnings of any company is currently very expensive. But let's not work with the worst case. Let's not work with the case that we see something like in the 1930s, right? The depression or the dot-com bubble burst. Let's work simply with what happened over here from November of 2021 to November of 2022, where the Shiller PE ratio went from 38 to 28. That seems to be somewhat of a reasonable correction, right? Or let's see what would happen with the markets, so with stocks and with Bitcoin, if the Buffett indicator was to go down by roughly 50 percentage points, right? From 190% to 140%. That seems to be also a somewhat likely scenario, right? It's not 100% likely, but still, I don't think there's a probability of only 5 or 10% that we see this kind of correction. It's probably rather 30, 40, 50, maybe even more than 50% that we see a correction. Now, here is what happened to technology stocks from November of 2021 to November of 2022. They went down by 36%. Here is a long-term Bitcoin chart. Let's have a look at what happened with Bitcoin. Again, here is November of 2021. Here is November of 2022. It's a decline of 76%. So no real surprise over here. Bitcoin seems to be a levered bet on the technology stocks. When tech stocks go down, when tech stocks cough, then Bitcoin gets a cold. And we can see this quite nicely with the correlation coefficient. It seems like, especially in the last 3 to 4 years, the correlation coefficient, the 1-year correlation coefficient gets closer and closer to 1. In the early days, there was no real correlation between Bitcoin and the Nasdaq 100. Now we tend to be hovering closer and closer between a value of 1 and maybe 0.7. In other words, tech stocks and Bitcoin move in the same direction at the same time. Again, no real surprise because now more and more traditional finance money, more and more Wall Street money is flowing into Bitcoin. And Wall Street doesn't necessarily buy Bitcoin because they believe it's the hardest of the monies. They mainly buy through the ETF. Wall Street buys because they simply think there's more potential alpha during times of monetary expansion. When times are rosy, when people want to get risk on, then Bitcoin tends to go up and it tends to get purchased by Wall Street. When times are not that rosy, then Wall Street will dump Bitcoin. And the question is, if we see a little bit of a correction in the traditional finance world, are you okay with a 70% decline in Bitcoin? Are you set up in a way that you won't go completely bust with your net worth if Bitcoin was to go down that much? I'm not saying that it will, but I'm also not saying that the likelihood is only 5% that this happens. It's probably much higher than that. We've seen corrections like this several times, even way more severe corrections. Bitcoin got started over here at the bottom of the global financial crisis. Bitcoin was launched at this point in time. This is a long-term Nasdaq chart. Bitcoin has never seen the Nasdaq drop by 80% or by 54%. During Bitcoin's lifetime, the largest correction ever was the 36%. And that's when it corrected by 76% during the exact same time frame, November of 2021 to November of 2022. Now, what is a good hedge against this? The most straightforward hedge would be, of course, to buy gold. Let's see how gold performed during those time periods. Did we really outperform the risk on assets that much, or is it just enough to hold plain old cash? The problem is that most people look at asset prices just in US dollars, and in that measure, gold tends to be very expensive. Is there really a difference in holding Bitcoin or holding the Nasdaq 100 when gold is also very close to its all-time high measured in US dollars? I believe yes, there is a difference. Let's first have a look at this correction, right? November of 2021 to November of 2022. What we've got over here is the gold price divided by Bitcoin. During the same time period, gold outperformed Bitcoin by 310%. So this was a 4x. If you timed it perfectly and you sold your Bitcoin over here and you purchased it again over here and you held gold during this correction, you'd now have 4 times more Bitcoin than if you just hodled your way through. Now it is important though to time the market somewhat, because when we zoom out on this chart, we can of course see how Bitcoin outperforms gold over the long term. It outperformed way more in the early days, right? When Bitcoin was much smaller. It now tends to outperform less. And I'm simply just connecting the bottoms on this chart. I'm not doing anything overly scientific here, but we can also see that it's not necessarily super easy to find the perfect bottom. Gold still might underperform Bitcoin for a while. There is potential to still do worse by 34%. It's not that clear whether or not we will keep the low that we've seen in November of 2021. We might still go down more than 30%, relatively speaking. That being said, there is an upside potential of more than 300%. Nobody knows where things are going, right? Nobody has a crystal ball. It's simply just a game of probabilities. It's simply just figuring out what's currently comparatively expensive versus comparatively cheap. And that's then, I believe, a good gauge of what the weights in a portfolio should be, right? The thing that's expensive, we should underweight. The things that's cheap should be overweight. It doesn't make sense to be 100% in any single asset class, but I do believe that it makes sense to adjust the weightings over time. Now, what we've got over here is gold relative to the S&P 500 on a very long-term chart. So this is now a look at how expensive are stocks relative to gold. We already know that stocks are expensive relative to their earnings, and we know that they're expensive relative to the GDP, and we now also know that stocks are expensive relative to gold. This is gold relative to the S&P 500. We can also plot this the other way around. So this is the S&P 500 relative to gold, and we are definitely not at historical heights. Stocks in the year 2000 used to be 140% more expensive relative to gold. But again, that was at a time when the Shiller PE ratio was also historically high. In the last 150 years, we have barely seen a time where earnings were that expensive to purchase. The vast majority of time, earnings were way cheaper. And so gold relative to the S&P 500 is not that expensive. Again, a potential upside of 280%. Maybe if there's a huge crisis, even 1,600%. What's the risk relative to stocks? It's higher, it's 59%. Now let's say we don't just see this small correction here. So let's not say that November 21 to November 22 repeats itself. Let's say we see a real crash. Again, we're just playing with scenarios here because we should be prepared for everything. What happened if you sold your stocks at the peak of the .com bubble and you held gold instead, and then you sold your gold and bought stocks again at the end of the global financial crisis in 2009? So earnings were roughly 3 times more expensive at the top compared to the bottom. 45 Shiller PE versus 15 Shiller PE. The market cap of stocks relative to the GDP moved from 130% to 50%. From the peak of .com to the end of the global financial crisis, gold went up by 315%. If you didn't buy into the .com hype and you actually cycled to something risk-off during the crash, you would have made some money. Now 300% doesn't look like huge gains, but relative to staying risk-on, it is huge. Because have a look at this. This is gold relative to the Nasdaq 100. It went up by 1,400%. From 2000 to 2009. If you didn't keep on holding your technology stocks, but you moved into gold for those 9 years, you have 15 times more money. That's the kind of leverage we get, right? The earnings only got 2/3 cheaper, but by moving into something risk off that even appreciates during times of crisis, we get a really nice levered effect. And so a small blip over here where we move from Bitcoin to gold and where we don't get through such a 76% depression, that little change can already make 300% gains. But playing the game even further and selling technology stocks for gold at the peak, peak and riding this all the way through a 9-year depression. That makes even 1400% alpha. I believe those moves get underappreciated. A lot of people simply put all their headspace into what kind of stock should I buy or what kind of altcoin should I buy. But actually the main alpha, I believe, is in simply riding the macro, trying to figure out what is currently expensive, what is currently cheap. And it's really the relative valuation charts that I believe are key here. What are the prices relative to earnings? What are the prices relative to the overall income of a country? What are the prices relative to precious metals? Those kind of relative valuation charts make way more sense because the US dollar over the long term inflates. If you just look at a gold price chart like this and you see it close to an all-time high, there would be no reason whatsoever to buy gold. Why should we buy gold when it's that expensive? But really, it is not expensive. Gold is relatively speaking cheap. Again, I didn't make a single statement on where I believe the market is headed. I'm simply just making statements on what currently is cheap in my opinion and what currently is expensive in my opinion. And the only thing I'm saying is that it might make sense to own the things that are comparatively cheap and to own less of the thing that is comparatively expensive. It doesn't mean that we have to own 90% gold in our portfolio, especially if you're still young and especially if you've got 40 years of earning ahead of you. But when you've got 5, 6, 7, 8 years of income in wealth and you plan to retire in a few years, then probably having this all in Nvidia and in Tesla stock is not the best idea. I'm talking more about those kinds of concepts in the premium membership of this channel. So feel free to check it out. It's down below. It's thebitcoinstrader.com. There's a 7-minute video explaining everything, explaining all the benefits. And there's more than 100 tutorial videos on managing a portfolio, on risk mitigation, on generating alpha, on buying the things that currently make sense. If it's your first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. See you in the next video or see you in premium. Cheers.